The FX market has a erratic movement on last Friday and as well as in today's Asia session due to the heightened risk of a joint intervention by the Bank of Japan and the US Federal Reserve Bank of New York to weaken the dollar against the Japanese yen. That being said, the dollar yen weakened to a level that was not seen since August 2025, which we highlighted in last Friday daily dose to be on the lookout for this intervention risk on the dollar yen, which eventually it broke below the 158 figure level and as well as the 15750 level and trading much lower in today's Asia session, finally in line with the broad-based US dollar that was being seen in the major US dollar pair last week. Whipsaw around the major US stock indices due to a heightened risk of a US threat that may attack Iran, where US President Trump tweeted that he's now sending a US strike group over the coastal area of Iran. And that also causes the oil price to rally by 1% towards our $61 per barrel on the West Texas crude oil. Interestingly, rising geopolitical risk premium due to the US threat on Iran and as well as the weakening of the US dollar dramatically on last Friday triggered a continuation of that bullish acceleration phase as expected on gold XAU/USD that managed to clear above the US dollar $5,000 per ounce, and as well as silver XAG/USD that cleared past the $100 per ounce. Very good morning to all, and I wish you guys a brand new trading week ahead. I'm Kelvin here. Welcome back to today's very interesting of Daily Dose of Market Insights. Today will be the Monday, the 26th of January 2026. And before we kickstart the gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so before we kickstart the daily dose, just to make sure that everything is okay. All right, so give me a minute, just 1 minute, just to make sure that everything is good. I think everything should be fine. All right, so let us start with the relevant news flow that has taken shape on Friday, which is primarily focusing on the FX market. I want to stress, and very important. Why? Because previously we see such movement in the strengthening of the yen that could lead to a significant negative feedback loop on the major risk assets like a intraday sell-off across the board in global equities, but that does not take shape. So what do I mean by that? So let me very quickly share with you guys what has taken shape so far. All right, let me go to my screen. All right, so let us touch on the FX market first. Okay, so FX market dramatically, finally, that K-shaped performance of the dollar yen has been evaporated, where we see a plunge down in the dollar yen, trading down negative 2.52% based on the 5-day rolling performance basis, finally in line with the weakening of the broad-based US dollar trend that is being seen in the major currency last week. So the weaker so far is still on the dollar Aussie, where the dollar Aussie is down by almost negative 3%, and that also created a negative feedback loop on the dollar Kiwi, which is down by negative 2.74%. So very clearly over here is that we know that the Aussie dollar is also being used as a risk on risk off proxy. So if there would be a carry trade unwinding by this sell-off in the dollar yen, potentially it could lead to a strong rebound on the dollar Aussie. That means the dollar strengthening very strongly against the Aussie, being Aussie as a risk, being a Aussie being used as a risk appetite currency, but that doesn't take shape over here. So very clearly, we know that earlier, the previous fear where we see a weakening of the dollar yen, that means the yen strengthened erratically and cause a unwinding of carry trade, the dollar Aussie would spike up. That means the dollar gaining very strongly against the Aussie due to the Aussie yen unwinding of the long side of the story. So very clearly, the yen is not being used as a traditional funding currency anymore so significantly. So that's why we are seeing a lesser negative impact on this carry trade unwinding by this steep sell-off in the dollar yen that has taken shape on last Friday and extending into today's Asia session, as the dollar yen is now trading down almost 1%. So what causes the dollar yen to actually spike down is due to the risk of this intervention risk, where the Prime Minister actually announced on the weekend some warning regarding about this significant weakening of the Japanese yen that was seen 2 weeks ago. So this the currency advanced to 153.98 per dollar, breaking below the 157.50 range support that we highlighted on Friday daily dose, where we warned of this intervention risk, and this intervention risk potentially has resurfaced in the market. But so far, there's still no official announcement that an intervention has been made. But very likely, those very short move that was seen on last Friday points to either a kind of a rate checking and smells like indeed a intervention risk. So there was actually a warning on the market made on Sunday by the Prime Minister Takashi, and signs on Friday that the US may join Japan to defend the yen. All right. So this is the so-called the joint intervention. So during the so-called this kind of joint intervention, let's say that there could be a carry trade unwinding. And firstly, the Nikkei 225 got hit as much as 2%, but this is the cash market. So let me share with you what has taken place on the futures market so far this morning. So in the futures market, right, that fall was not that significant, all right? So the Nikkei 225 futures that is trading almost down only negative 0.21%, and is now trying to recover from the session low. So the Nikkei 225 futures take into account of last Friday price action trading as well during the US session, where the Nikkei 225 futures also sold off. But right now, the Nikkei 225 futures is actually trying to actually recover by negative 0.21%. And if you look at other Asia benchmark stock indices that is trading right now, not so much of a negative impact as well. So if you look at the Hang Seng Index, is trading almost unchanged at negative 0.04%. There was some hit on the China big tech stocks that is listed on the Hong Kong Stock Exchange, as represented by the Hang Seng Tech Index, which is down by negative 1.7%. But however, if you look at the mainland China stock market, the CSI 300, which is up by 0.23%, the much more narrower China A shares is up by 0.24%. And you go to other Asia Pacific stock market, even the ASX 200 is up by 0.13% now. Yes, the Kospi 200 got hit by negative 0.52%. However, the Taiwan Stock Exchange is up 0.47%, and the Singapore's STI is down by negative 0.21%. So what we could see over here is that we do not see a very, very significant risk of environment that is taking shape right now on the global stock market based on the various key Asia Pacific benchmarks stock indices performance on the intraday basis at 11:10 a.m. Singapore time we had just shared. So what it implies over here is that the current strengthening of the Japanese yen, or i.e. the steep weakening of the dollar yen, does not translate to a significant carry trade unwinding. That means, i.e., the yen itself may not be used as a carry trade right now in the global markets. So that actually explain the correlation movement right now has starts to broke down. That means previously we see steep fall in the dollar yen, it could potentially lead to a dramatic risk risk-off impact on the global risk asset like the global stock market, but it's not taking shape right now. But however, one thing that is much more isolated in the US stock market is more pertaining to risk that is inherent on the US economy. Later, I'll share you very quickly what's happening. The E-mini futures is actually down negative 0.3% right now, but it's still trading from the session low over here. What you could see is that at 7 a.m. it was down much more at 6,893. This is the S&P E-mini. Now it's trading higher at 6,926 over here, right? At the open, it was kind of, let me open up. Yeah, it was at 6,893. And the Nasdaq 100 E-mini is also down slightly by negative 0.42, but it's trading off the session low at around 25,453, and now it's trading at 25,628. So what causes that initial sell-off on the E-mini futures at the start of today's Asia session is actually due to this civil unrest or civil protests in Minneapolis over here. So there was an unfortunate event where ICE agent shot down a Minneapolis we call it citizen, and we know that Minneapolis is under the control of the Democrats, and right now the Democrats leaders in the Congress, especially in the Senate, has now proposed to threaten a partial government shutdown again by not by voting to block a massive spending bill. All right, so Senate Democrat leader Chuck Schumer vote to block a massive spending package unless Republicans strip funding of the Department of Homeland Security, increasing the risk of a partial U.S. government shutdown again. All right, so that actually created a intraday negative feedback loop into the U.S. stock market. So bear in mind that this week US stock market will also face a two-way volatility risk much more heightened. Why? Because of various confluence of risk event that is taking shape. Number one, we will have the US Federal Reserve monetary policy meeting, and most importantly, market participants will be hearing Fed Chair Powell's speech to see whether the Fed is still inclined to extend their interest rate cut cycle so far. And we have 4 mega cap technology stocks that are reporting their Q4 earnings this week as well. So potentially two-way heightened volatility, and together with this internal risk of civil protests in one of the key Republican states, Democrat states, pardon me, where Democrat leaders now voting to actually do this kind of brinkmanship play to partially shut down the US government over this unfortunate event that has taken shape in Minneapolis over the weekend. Right. So then we also have this Trump move on the weekend, where he actually sent US ships to the Middle East to renew his Iran trade over here. So Trump has dispatched naval assets to the Middle East, prompting speculation that he will follow through on threats to attack Iran leadership amid violent crackdown on Iran nationwide protests. So that actually may also create two-way volatility in the global marketplace, especially on the West Texas crude oil. But later I'll share with you the West Texas crude oil on a technical perspective. It still can't break above this stubborn range resistance of $61 per barrel. All right, so that sum up the first segment of the daily dose. All right, so let us now immediately move on to the second segment of the daily dose, which is all the intraday technical outlook segment, starting with the FX market. All right, so let's start with the FX market first. But before we jump straight into the individual FX dollar pair over here, let me very immediately touch you on the US dollar index. All right, so with that, let me expand this screen and let me share with you that full screen as well, so that you guys could have a better view of the charts. All right, so over here, you can see this is the US dollar index. All right, so the US dollar index, I do mention earlier that with this breakdown of this ascending trend line support drawn from the low during the Christmas break, indicating that whatever rebound that is being seen on 24th of December all the way up to the high of 16th of January this year is a dead cat bounce, where it continues to be trapped within this medium term and major range resistance that has been in place since 1st of July. And based on the bearish breakdown that was seen on 20th of January, breaking below the 20-day moving average, the 200-day moving average, and reintegrating back below the 50-day moving average, there's a high chance that the dollar index may see further weakness to float back down towards the lower limit of this complex range configuration, which indeed plays out truth. All right, so far, right now, is now hitting that range support of 96.40. If we start to see a weekly breakdown below 96.40, that means, i.e., the dollar index will start to transit into a major medium-term range resistance into a major downtrend phase. That means, i.e., it could ignite a multi-month, potentially multi-month down move on the US dollar index to revisit the next support level at 93.2. That means indicating much more broad-based US dollar weakness. So the only way that this US dollar downtrend that could reverse again and to prevent it from breaking down below 96.4, in my own opinion, in the near-term horizon, it will be all lines on the US Federal Reserve monetary policy guidance that will be released on this week, especially during a Fed Chair Powell press conference. So that could only potentially allow the US dollar index to continues to be trapped inside this complex sideways range and rebounding off from the 96.4 level. But at least on a very short-term basis, ahead into the US Federal Reserve meeting, there is still be a multi-day weakness as we got some more move for it to come down towards 96.4 before this Thursday early Asia session, 3 a.m. US Federal Reserve monetary policy decision. All right, so that being said in mind, let us now focus on the euro dollar. So the euro dollar rallied as expected and hit our resistance level at 118.60, and right now attempting to revisit the 3rd of July / 3rd of September 2021 swing high at 119.10, and so confluence with the 1.382 Fibo extension of this ongoing bullish impulsive upmove sequence ever since it managed to survive on the 200-day moving average on 19th of January this year. So let me slash this 119.10. All right, slash 119.10, 119.30. So with that, I will use a Titan short-term pivotal support level. In any case, there could be a chance of a minor pullback over here. So minor pullback, first support level to watch, given that why I say there could be a risk of a minor pullback, because RSI now is inching down and about to exit from the overbought level. But however, there is no bearish divergence that's being flashed out on the hourly RSI, indicating that the risk of the probability is for more of a minor pullback rather than a steeper minor pullback over here. So this minor pullback to support level, a gentle minor pullback, I would say. This gentle minor pullback to support level to watch will be the gap up support level that is being seen in today's Asia session at 118.33. Maximum will be at 118 figure level, 117.90 figure level, which is this stubborn minor range top previously that has been formed on 16th of December and 24th of December, decisively broken out on last Friday. So this will be the critical short-term pivotal support level to watch in today's Asia session to hold this direct bullish push up after this minor pullback, gentle pullback has ended towards the next resistance level at 119.10, 119.30. Above it, potentially seek out 190.60, 119.80 next. And the 180 figure level, 117.90 figure level, also confluence with a Fibo retracement level that is close to 38.2%, drawn from the minor swing low of 22nd of January all the way up to this Monday Asia session high over here. Only a bearish breakdown and the hourly close below 117.90 will invalidate this direct bullish bias move to see a much more deeper minor corrective pullback unfolding towards 117.55, maximum 117 figure level, which correspond with the 200-day moving average as well. So that's for the euro dollar. Next up will be the sterling dollar. The sterling against the USD also rally up and hit our resistance as expected, and right now is fast approaching this congestion area of 136.80, 137.15 that was formed previously last year from 27th of June to 4th of July, and so confluence now with the 2 times Fibo extension of this ongoing bullish impulsive upmove sequence from 19th of January. So still recall that last week we do highlight that do keep a lookout for this bullish move, and this bullish move will trigger due to that last week impending minor inverse head and shoulder formation, which we highlighted earlier on as well. So with that, price action now broken above this medium-term ascending channel resistance that I drawn from the low of 5th of November now turns into a critical near-term support level at 135.88. So minus potentially, I do not want to, because in between here, there is no significant support level to watch either than the first support, which is the gap up that is being formed in today's Asia session at 5 AM Singapore time. So right now, as we are speaking at 11:21 AM Singapore time, is still holding, which is at 136.46. So maximum allowable minor pullback for today will be 35.88. So as long as this 35.88 key tighten short-term pivotal support holds in any chance of any minor pullback, if 136.46 is taken down to the downside, I was still looking for a bullish bias. Any chance of a bullish reversal candlestick that appears slightly above 135.88, I will still maintain a bullish bias to continue this ongoing bullish impulsive up move sequence on the sterling against the dollar. Above 137.15, potentially take us up higher towards 137.65, 137.90 level. If we go all the way back to the daily time frame, is actually this congestion area here of 1 minute of minor swing high of 26th of June 2025 and 2nd of July 2025 over here. All right. And also the 2.618 Fibo extension taken from the low of 19th of January, all confluencing at this 136.65, 136.90. However, only a bearish breakdown below 135.88 with an hourly close below it will invalidate this direct bullish bias move on the sterling dollar to see a much more deeper minor corrective pullback unfolding towards the next two near-term support level at 135.30, maximum 134.90 / 134.83. We also confluence with this rise, this turning up 20-day moving average as well. So that's for the sterling dollar. All right, so next will be the high-flying Aussie dollar, which we mentioned last week as one of our bullish move, a pre-bullish move that indicate this broad-based dollar weakness. So the Aussie dollar, pardon me, rallied as expected and hit our resistance level at 68.73, 69 figure level, and now approaching 69.40. So 69.40 is a Fibo extension of 1.618. And if you go to the daily time frame over here, so 69.40 is the medium-term swing high of 30th of September. Okay, let me delete this. All right, it's a medium-term swing high of 30th of September 2024, previously there. All right, so let us now go back to the daily time. And right now, it also appears above the expanding range resistance level that I drew from the high of 7th of May. So indicating a bullish acceleration phase that is undergoing on the Aussie dollar over here. All right. So with that, from a risk management perspective, I will have a rather tight short-term pivotal support level for today. As long as any mild, minor, shallow pullback didn't surpass below 68.73, tighten short-term pivotal support level, I will still have a bullish bias on the Aussie dollar above 69.40, potentially take us up towards the next intermediate resistance at 70. 10, 70, 30 level over here, which is a Fibo extension cluster level. Okay, let me draw it for you guys to see. All right, 4.236. This 69.40. And if we do it from here, all right, 70.40 is 2.618. All right, over here. So 70.30 was a graphical congestion zone previously. So this is the resistance level to watch after 69.40, 70.10, 70.40, maximum 70.10, 70.30, maximum 70.40, right? However, a bearish breakdown below 68.73 with hourly close below it will invalidate the direct bullish bias move on the Aussie dollar to see a much more deeper minor corrective pullback unfolding today towards 68.35. 68 figure level, maximum 67.60 level, which is this former 11th of October 2000 swing high that was rejected previously at the start of the year, 7th of January, now turns into a critical pullback support level, right? So that's for the Aussie dollar. Still maintaining that bullish bias view using a tighten short-term pivotal support level for today at 68.73. Next up will be the dollar yen. So dollar yen, before we jump into the hourly time frame chart, this dollar yen very clearly it broke down below the 20-day and the 50-day moving average. And whatever, yes, last Friday move with this steep down move over here smells like intervention, even though there's no official words out yet. Even though it's not intervention, it could be due to authorities asking respective banks to do a rate check in the FX market, all right, over here before exact interventions start. But nevertheless, it has started to skew the sentiment of the dollar yen towards the bearish side rather than the bullish side, with the integration of with the breakdown of the 20-day and the 50-day moving average. And prior to the breakdown, there is a very clear bearish divergence that's being formed on the dollar yen, indicating that the medium-term uptrend phase from April 2025 is now at risk of breaking down. All right, so we're taking things one step at a time with various support level to watch from a medium-term perspective: 152.95, followed by 149.80, which is the 20-day moving average, and the very key ascending trendline support that managed to hold this ongoing graphical medium-term uptrend phase from the low of 22nd of April 2025. Last Friday, fall of negative 1.77% on the dollar yen is the worst single-day decline on the dollar yen since 1st of August 2025 last year. All right, over here. So now it's breaking below 15440/15370 support level, which is this congestion area here that was previously formed on 30th of October and 16th of December. Now let's take you through the hourly time frame chart to share with you guys the intraday levels to watch on a hourly basis. So given that price action now is now coming very close to this 15370, and there is now a bullish divergence that's being flashed out. All right, so with this bullish divergence being flashed out, right, there could be a risk that the dollar yen may bounce back again towards this gap resistance over here that is being formed in today's Asia session. Okay, oops, come on. All right, okay, so given that also right now is hitting the 2.618 Fibo extension as well, indicating the downside impulsive wave 3 target has already been met exactly at the 15391, which is very close to 15370 as being seen on the daily time frame chart. And with this bullish divergence in mind, there could be a minor dead cat bounce taking shape to retrace it. So what potentially that it could happen in terms of this movement over here, it could do this kind of move before heading downwards again over here. All right, with this corrective rebound taking shape, given that the impulsive wave 3 target has been met, and there could be now a minor corrective wave 4 taking shape, which is a typical Fibo retracement of 38%, 38.2% over here, maximum, minimum 23.6%, which is very close to the gap resistance level. So what it means that over here is that given the bigger picture is still on the downside, whatever move that is going upwards, I will fade that move to potentially skew, have a bearish bias on the dollar yen. So resistance level to watch for this corrective rebound to stall will be at potentially at 155.35, 155.60 over here, and maximum 156.19, which is the former 6th of January minus swing low, now turns into a pullback resistance level. So as long as this bounce, as long as this bounce didn't surpass above 156.19, whatever bounce that we have, I will try to actually still have a bearish bias to fade that bounce. Next support level to watch after 153.70 on the intraday basis will be 152.90 over here. So 152.90, if we go back to the daily time frame, what is it? So 152.90 or 152.95, I would say, is the congestion area of 9th of October and 6th of November last year, and as well as this dotted gray line here, which is the pullback support of this former descending trend line that previously was I drew from the high of 3rd of July and 10th of January 2025 that was broken out on the 17th November last year, now turns into a pullback support at 152.95/152.90. So this is how I derived the 152.90 support level. All right, so far the graphical support level. However, if price action continues to squeeze upwards towards above 156.19, then this bearish bias will be invalidated in today's Asia session for the price action to squeeze higher towards 15664, 157 figure level. Maximum our medium-term pivotal resistance level will be at 15750, which was our range support level that we have for the entire week of last week before it did that bearish breakdown, now turning into a critical medium-term pivotal resistance on the dollar yen to cap further upside move of the dollar yen at 15750. All right, so that's for the dollar yen on the intraday bias and the key levels to watch. Now, with that, we have already summed up all the intraday technical outlook on the major stock indices. Let us now move on to actually share with you guys what I am seeing on the other major stock indices. Okay, so let's now move on the major stock indices. All right, starting with the Hong Kong 33. So over the Hong Kong 33, it continues to hold above this rising 20-day moving average, which is our pivotal support on last Friday at 26,480, and also the lower limit of this ongoing minor ascending trend line that has been in place since 16th of December. Right now, about to turn into a medium-term ascending trend line, given that it's more than a month already. All right, so with that, no change on the Hong Kong 33 in terms of the levels to watch and the trend bias. Still, oops, come on, what's going on? Okay, sorry, this is the Hong Kong 33. Let me expand it. So still maintain that bullish bias on the Hong Kong 33 using 24,480 as my short-term pivotal support level, upside trigger level. Indeed, 26,922 that got earlier rejected in today's early Asia session at the start of the Hong Kong stock trading session in the cash market. So a clearance above 26,922 will gain more credence to allow it to retest this range resistance level that has been in play since 13th of January, 26 minor range resistance, I would say, at 27,175. So these are the two key resistance levels to watch. Unless we have a significant bullish breakthrough and an hourly close above 27,175, then potentially we could see further up move towards the major resistance level at 27,500 next. However, a bearish breakdown and hourly close below 26,480 will invalidate today's bullish bias move on the Hong Kong 33 that is representing the Hang Seng Index to see a minor corrective pullback sequence unfolding deeper on the downside to retest 26,330, 26,250 next, maximum the 50-day moving average that is confluencing with the minor swing low of 8th of January at 26,045, 25,970. Okay, next up will be the dollar yen. So the dollar yen, last Friday, we have a very tight short-term pivotal support level, pivotal support break, and negate our direct bullish bias view, but float down towards our support level that we want to flip into a bullish bias again, which indeed it managed to survive right exactly at the 20-day moving average and also shape a bounce right exactly off this minor former descending trend line now turns into a pullback support level that is confluencing at 52,060, 51,837. So using 50, given that this bounce has already there's indeed a bounce coming into play, so I cannot have a bearish bias for this support level to break and for it to retest the 50-day moving average at 51,165. So instead, I'll be watching 52,060, 51,837, 51,837 to have a mild bullish reversal slash recovery scenario on the Japan 225, representing the Nikkei 225. Two key resistance level to watch for today will be at 53,100 followed by 53,570. If we able to see a breakout above 53,570, then potentially this recovery could extend further to at least retest the current all-time high area at 54,565. However, a bearish breakdown below 51,837 and an hourly close below it will invalidate this minor bullish recovery, minor bullish reversal scenario to see the extension of this minor corrective decline extending further towards the downside to revisit the 50-day moving average, which is confluencing very closely at the 8th of January 2026 swing low area at 51,165 in the first step. A breakdown below 51,165 will see a deeper corrective pullback towards 50,205, which is the minor swing low area of 30th of December and 31st of December. So that's for the Japan 225. Okay, next up will be the Germany 30. So Germany 30, not much impact. It's going to trade sideways during the US session. Come break above 24,970 and come break below our first support level at 24,700. So bearing in mind, still keeping these two levels in check, and we will still have a bullish bias given that this could be still a bullish pennant formation. But however, price action got to break out fast above 24,970 for it to cover the gap down resistance that's been formed on the previous Monday last week at 25,081 and 25,260. So unless we have an hourly close above 24,970, we saw confluence with the 20-day moving average acting as this intermediate resistance, and the former medium-term ascending support now turns into a pullback support exactly at 24,970 as well. Hourly close above 24,970 will solidify the probability of the start of a new impulsive upward sequence on a minor scale on the Germany 30. And that being said, I could adjust my pivotal support to 24,700 if such scenario materializes. So far, pivotal support still remains the same at 24,480, 24,375 over here. So unless we have a bearish breakdown below 24,375 and the hourly close below it, then that would negate the bullish bias move to see a corrective pullback, a much more deeper corrective pullback taking shape to retest the 50-day moving average at 24,250. A breakdown below it exposes the next support level to watch will be the key 18th of December swing low area at 23,885 that confluence with the 200-day moving average as well. All right, so that's for the Germany 30. Next up will be the major US stock indices. So the major US stock indices, let us now focus on the US Wall Street 30 first, which is representing the Dow Jones Industrial Average. So the US Wall Street 30 did a bit of whipsaw over on last Friday. And what we could see is that it broke down below our Titan short-term pivotal support level at 49,100 and met the second resistance level, second support level, pardon me. It broke down below our Titan pivotal support at around the 4,100. Then thereafter, it float down in today's Asia session, gap down, and now managed to recover at the next support zone, which is 48,770, 48,650. And what we could see now is that the hourly RSI hit the oversold level and flash out a bullish divergence. All right, over here, there's a lower low, but higher low on the RSI. So indicating that this morning downside momentum is likely to have dissipated. So with that positive encouragement that is being seen on the hourly RSI with that bullish divergence, I would use 48,770, 48,655 as my short-term pivotal support level for today. Have a mild, minor bullish reversal, bullish recovery view with the next two intermediate resistance level to watch on the intraday basis, 49,133, followed by 49,350. However, a bearish breakdown below 48,650 with an hourly close below it will invalidate this minor bullish reversal scenario to see a corrective pullback extending further to retest last Wednesday minor swing low area at 48,480, 48,340 next. So that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 managed to bounce off from our Titan short-term pivotal support that we have on last Friday, and the hourly RSI continues to remain supported by this parallel ascending trend line, and there's a slight gap down with an excess at 6,860. So with that, I will tolerate the access to 6,860, still maintaining that mild bullish bias on the SPX 500, 6,877. That was last Friday pivotal support, having access at today's Asia session intraday low, 6,870, where it shaped a bullish Marabuzu candlestick thereafter at the 8 a.m. mark Singapore time today. So still having that mild bullish bias scenario with the first intermediate resistance level at 6,945 to watch out for today. Only a clearance above 6,945 potentially will enable it to retest the current all-time high area at 7,000/7,005. However, a bearish breakdown below 6,860 that would invalidate today's mild minor bullish reversal scenario to expose the next near-term support level at 6,830/6,813. A breakdown below 6,813 may seek out the next intermediate support level at 6,744, which is the minor swing low area of 19th of December. So that's for the SPX 500. Okay, next up will be the Nasdaq 100. So Nasdaq 100 bounced off exactly at the pivotal support that we have on last Friday, 25,350. All right, so indeed giving us we call it evidence that this is indeed a pivotal support that attract some boost to come into play on the Nasdaq 100. But overall, the Nasdaq 100 still can't break above this stiff resistance that has been in place since 8th of December last year, which is 25,760, 25,830, and it got rejected previously on 15th of January. So still having this mild bullish bias unless we have a clearance above 25,830. So it's like a bullish bias within like a zone over here, like a range over here. So as long as this 25,350 short-term pivotal support is not surpassed on the downside, potentially the Nasdaq 100 may shape a continuation of this mild bullish reversal that is taking place right now to retest this stiff resistance level at 25,760, 25,830. Only an hourly bullish breakout and an hourly close above 25,830 on the intraday basis will allow the bulls to gain more traction for the next intermediate resistance to come in at 26,106. However, a bearish breakdown below 25,350 will invalidate this mild bullish reversal move towards the stiff resistance range stop and see it floating downwards towards the next intermediate support level at 25,105, 25,030, maximum 24,870, which is the congestion area of 16th of December and 18th of December. So that's for the Nasdaq 100. And sum up all the intraday technical outlook on the broad-based stock indices, all right, over here. So let us now touch on the commodities market, starting with gold XAU/USD. So gold continues to extend its gains and hit our resistance level at 5,094, 5,450, 5,149 within our expectation. So so far the hourly RSI is not showing any signs of a bullish momentum exhaustion as it continues to print out no bearish divergence. And given that it's being overbought right now, that could be a slight pullback over here. So pullback level to watch out for today will be the 5,000 level, 5,005 level, which is also the gap up support level that's being seen in today's Asia session. So using last Friday European session low, which managed to shape a bullish reversal after the retest of that former minus swing high of 21st of December. So that will be at 4,888. All right, so having a tightened short-term pivotal support at 4,888 still maintain that ongoing bullish acceleration phase on the gold XAU/USD. Next resistance level to watch after 5,149 will be at 5,227, 5,242, followed by 5,325, 5,384, or defined by a Fibo extension cluster level. Only a bearish breakdown and the hourly close below 4,888 that would invalidate the direct bullish bias move to see another round of deeper minor corrective pullback scenario to expose the next intermediate support level at 4,775, 4,685, which is this former congestion area here of 19th of January, maximum 4,645, 4,600 level, the previous gap up that was formed on 19th of Jan, and also the rising 20-day moving average. So if price action hit down around this zone here, 4,684 and 4,645, I'll be on the lookout for a bullish reversal candlestick again, given that the medium-term uptrend still remains intact on gold XAU/USD as it continues to rise above, continues to trade above the 20-day and the 50-day moving average. So that's for gold XAU/USD, still maintaining a bullish bias with a tightened short-term pivotal support for today at 4,888. Next up will be the West Texas crude oil. So West Texas crude oil continues to face a bit of hesitance by the bulls at our pivotal resistance that we have on last Friday, 61.17, 61.35. And what's interesting over here is that the hourly RSI now has flashed out a bearish divergence, all right, indicating the lack of upside momentum as it approaches the resistance level that we highlighted. So as long as this 61.17, 61.35 short-term pivotal resistance holds today, potentially there could be a mild retracement pullback on West Texas crude oil. First support level to watch will be at 60.30 over here. 60.10, pardon me, not 60.30, a bit of tongue twisting. 60.10. All right, 60.10. Breakdown below 60.10 potentially exposes 58.76, which is so far the minus swing low that has been in play at 19th of January and almost being retested on last Friday, on last Thursday, which show confluence with the 20-day and the 50-day moving average. However, bullish breakout and the hourly close above 61.35 will see a squeeze up towards the next intermediate resistance at 62.45, 63 figure level, which confluence with the key 200-day moving average as well. So that's for West Texas oil. And that sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? All right, sorry, let me share with you where's the key data. Yeah, right, so today will be Monday, the 26th of January. So let's go all the way up. Okay, so 26th of January, key data to look out for during the European session will be a slew of Germany business sentiment indicator. They call it the IFO business climate and the IFO current condition. So that will be out at 5 p.m. Singapore time today. So market is expecting the business climate for January, which is the business confidence index, to inch up higher to 88.1 from 87.6 that was printed previously in December. So that could potentially influence the euro dollar, the euro crosses, and in some form the Germany 30 CFD index. So that will be at 5 p.m. Singapore time. So over the US session for today, there is no tier 1 data to take note of. And also before the start of our daily dose tomorrow on 27th of January, there's this Australia business confidence data as compiled by a National Australia Bank NAB at 8:30 a.m. Singapore time. So that could potentially influence the Aussie dollar, the Aussie crosses, and the Australia 200 CFD index. So like I mentioned, for the earnings calendar, this week will be pretty much key on the major US stock indices, especially the Nasdaq 100 and the S&P 500, because they are much more heavily weighted on the mega cap technology stocks. So kicking off over here will be on this Wednesday. You have 3 mega cap technology stocks reporting: Microsoft, Meta, and Tesla. So that will take shape right after the closure of the US session. So on Wednesday, we also have the FOMC meeting as well. So it could be a very volatile session after 3:30 a.m. Singapore time. And we know that Microsoft, Meta, and Tesla will report their earnings at 5 a.m. Singapore time, after 5 a.m. Singapore time on the 29th of January. So this Wednesday, but it's after the close of the US session, which is early 5 a.m. Singapore, after 5 a.m. Singapore time on 29th of January on Wednesday. And on Thursday, 29th of January, Apple will report its earnings. So that will be the close of the US session on Thursday, 29th of January. Singapore timing will be after 5 a.m., 30th of January, Friday. All right, so these are things to look out for, but we'll touch on more about that as we approach our daily dose on a day-by-day basis as this week develops. All right, so with that, have a great day ahead today, and we shall speak again tomorrow. Thank you.